Okay, folks, we are going to kick this off. So thank you so much for joining us today. My name is Mike Walker. I am the president of the Voluntary Benefits Shop. I will be your host for today's presentation. Let's start with just a couple of housekeeping items. Today's presentation is being recorded. If you want to access it after the fact, you certainly can. Generally, these are on our website, so you can check out our website and be able to have access to these webinars that we do. We do this type of webinar every month for the broker community, different topic all around long-term care, life with long-term care. If this is your first time joining us, welcome, glad to have you. If you're a long-time, visitor to this webinar, we appreciate having you back. I notice some of the names there that I see on the attendance report, so certainly glad to have all of you with us today. You can enter questions into chat. Feel free to, if a question pops up, to enter it into chat. I'll also, pause at the end and allow people to unmute and be able to ask some questions as well. So you will have the ability to be able to do that. With that, let's go ahead and kick this thing off. So again, Mike Walker, Voluntary Benefit Shop. Here's my contact information. For those of you that aren't familiar with us, my quick commercial. All we do is handle life with long-term care implementations for brokers and their clients. We work with agencies all across the country to bring these life with long-term care solutions to clients with a process that creates a very, very comfortable educational journey for employees so that they can get to the point where they understand the concept of long-term care, understand the solution that these hybrid products offer, and are in a position where they can make an informed decision for them and their family. In fact, our process generates results that are about 5 times greater than industry average, and we get great feedback on it. But that's the end of my commercial for today. So with that, we will jump into the content for today's presentation. So today we're talking about long-term care planning as part of retirement readiness. Some of you that are in that industry have that conversation every day. This is second nature to you. You get it. You're telling people this all the time. But what I find is a lot of times, even within our industry, the benefits industry specifically, you have a lot of advisors that are not that well informed on the need for long-term care, believe it or not. I hear stories about this, all the time when I talk to folks about things that they went through with their parents, and they were surprised to find out what Medicare or Medicaid, how that comes into play. So there's definitely a lack of information, not only in the general population, because that's certainly the case, but certainly even among some of us in the insurance industry. I know until my organization really focused on this product, I definitely didn't have a great understanding of, long-term care and the need for it amongst the population. So we'll be spending a little time today talking about that. I think it's important to kind of think about, I've simplified this, right? I've broken life down into 4 phases, which is certainly a simplification. But I think it's important to kind of notice this or recognize this, that we do go through some very significant different time periods within our life. Certainly childhood, where we're being taken care of, young adulthood, where we get an education, we start our careers, and start to take care of ourselves. Adulthood, which lasts a long time for most of us, where we're taking care of ourselves, starting a family, and starting to prepare for retirement during that time period, right? Starting to build up that nest egg. And then ultimately retirement, where we we want to enjoy our time, be relatively stress-free, and we are, during that time period, starting to utilize that nest egg that we've built. Now, the problem is, with retirement and that nest egg, is that there are a lot of risks to that retirement nest egg. And this is, of course, also an oversimplification, but, 4 big risks to your retirement assets. You have the inflation risk. That inflation is going to erode your overall spending power. Can't do anything about that other than, try to save more money. Longevity risk. People are living longer and longer, right? Lives, sometimes healthier longer, sometimes not healthier, but still longer. And so we can outlive our assets in some situations if we don't plan and protect correctly. And then sequence of return risks, right? When we have our our assets invested, those values can go up and down with the markets, whether that's the real estate market, the stock market, whatever the case may be. We can certainly see some swings in our overall asset base. And then lastly, and probably most pertinent for today, we have those healthcare and certainly long-term care risks. The reality is that, most of us, I think, know Medicare doesn't cover everything, especially long-term care costs. And so we're going to talk about that a little bit more as we go. One stat that's interesting here at the bottom, you can see Fidelity Investments estimates that a couple retiring at age 65 will need approximately $345,000 saved just to cover out-of-pocket healthcare costs in retirement. That's not including living. That's just healthcare costs. Okay, so for most people, that's a big number. Now, a couple of things, 70% of us, after the age of 65 will likely need some shape, form, or fashion of long-term care services. 20% of us may need that care for longer than 5 years. It's a long time. And the bigger part of that is the cost. Here's the national averages from 2025. $80,000 is the average cost of in-home care. Nursing home care ranges between $115,000 and maybe $130,000, depending on the type of room. And the estimated cost of care for the final 5 years of life for a person with dementia is about $367,000. So we can all identify with the fact that these are big costs. When our clients aren't prepared, when we're not prepared, these costs can really negatively impact the financial security of the family. Retirement assets can be depleted, family assets can be depleted. And that's the bad news. The good news is, hey, our job as advisors is to help our clients, whether that be HR level clients or employee level clients, understand that there are ways to protect themselves against this type of exposure. And the key is how do we best communicate that? How do we get them to understand that? One of the challenges out there, and certainly I think all of you on this call probably know this, or maybe some of you don't, but one of the biggest challenges is that people don't really understand how long-term care services are or are not covered by things like health insurance, Medicare, and Medicaid. And so certainly, health insurance doesn't have anything to do with long-term care costs. Now, Medicare, which is probably the biggest, mystery to folks in terms of how it, covers long-term care, Medicare can pay for care in a nursing home in some very specific rehabilitative types of circumstances. But that's really only for a maximum of 100 days. So that's really more short-term care, right? Not long-term care, that's short-term care. And after 100 days, a family's pretty much on their own. And while Medicaid can pay for care in a nursing home, now that's really only if someone has exhausted the majority of their savings and assets. And even then, it's limited to a facility that accepts Medicaid, which can really limit someone's care options, geographically and probably from a quality of care perspective in a lot of circumstances as well. And you heard me say that, Medicaid doesn't kick in unless someone has exhausted the majority of their savings and assets. In most states, that means you have to have less than, say, like $2,500 worth of savings and assets remaining before Medicaid would come into play. And even then, again, like I said, it's limited to facilities that accept Medicaid. So the point is that none of these are really planning vehicles for being prepared for long-term care, which would be okay if most people understood that. But let me show you a couple statistics that point out how uninformed we are as a population about that reality. So according to the Nationwide Retirement Institute, 58% of surveyed U.S. results wrongly believe that Medicare covers long-term care. So almost 60% of us. And then according to the Kaiser Family Foundation, 45% of adults age 65 and older assume that Medicare would foot the bill for a nursing home. Now think about that. That's folks that are living this. They've seen it with their parents. They've seen it with their peers in some circumstances, right? And still, 45% of folks over the age of 65 assume that Medicare would foot the bill for a nursing home. So think about the younger part of the population, right, that hasn't seen as much yet. So the point is that this is very much an uninformed topic throughout the population. And let me give you a snapshot of what could happen, right, to someone. And I'm going to use my hometown here where I live as an example. So let's consider a middle-class married couple, John and Mary. in their early 70s. They reside near Havre de Grace, Maryland. That's where I sit today. That's where my office is. That's where my home is, 5 minutes up the street. And so John and Mary, they have a combined net worth of about 650,000, or I'm sorry, yeah, 650,000. So, solid middle class, living there. And that consists of a 350,000 paid off home, $200,000 in 401k retirement accounts, and about $100,000 in liquid savings. And they have, modest retirement income from Social Security that helps cover their standard living expenses, right? So this is, the bulk of the population. The reality is it doesn't matter what these numbers look like, right? Because everything's relative. But there's a triggering event. John suffers a debilitating stroke and requires continuous in-home assistance, followed by a transition into a specialized memory care or skilled nursing facility. Okay. So what happens then? So there's a financial toll. Here in the Mid-Atlantic area where I live, nursing home care ranges from about $115,000 to $130,000 annually. Let's say John needs full-time care and for 3 years, and the total cost of that care is roughly $360,000. Okay. Now the financial toll of that to the family. So because Medicare only covers the first 100 days of skilled nursing, John and Mary must pay out of pocket. Okay. So they liquidate their $100,000 in savings. They cash out they cash out $260,000 of their 401k to help pay for this facility. And there's some other factors too. So when they cash out that large portion of their 401k, now they have a tax obligation, right? Pushes them into a higher tax bracket. They got to pay, taxes on that money. So that even faster accelerates the depletion of their assets. Okay. So not a great situation. The outcome is that eventually John qualifies for Medicaid to cover his ongoing care, but only after they've liquidated nearly all of their wealth. Mary's left to survive on her remaining retirement funds and Social Security. The family home may be shielded from immediate forced sale by the Medicaid spousal impoverishment rules, but it could become subject to Medicaid estate recovery upon her passing. So instead of leaving a substantial inheritance, it may be that the family doesn't receive much at all when Mary passes, right? So it's not only about the stress that it puts on Mary long term. It's also about, I think most of us want to be able to pass those assets onto our heirs, certainly onto our spouse, but also onto our heirs. So guys, this is a snapshot of what could happen, and we hear stories about this all the time, and worse stories than this in some instances for sure. So this is a problem out there, guys. And the reality is the biggest part of the problem is that people are not educated on the need and on the solution. And so when we talk to people about why include long-term care as part of their retirement plan, it's really about preserving assets is a big part of it, right? Preserving their assets so that they're there, for the retirement, for the spouse, reducing family burden, right? Like we don't necessarily want to have to be dependent upon our loved ones for care, for finances, right? We definitely don't want to, we want to be able to reduce that family burden. Long-term care can go a long way in helping that happen. And then also maintaining choice, right? It gives us and our family a little more freedom to make choices when those choices are not dictated about, what we need to do to preserve our assets, right? Or to what we can afford, right? So it gives us some more leeway in terms of being able to choose the type of care that we want for ourselves or that we want for our loved one who's going through it. And so it's very, very, long-term care is a very, very important part of retirement planning. Protecting our assets is just as important as accumulating those assets. So folks, remember, you can enter any questions into chat that you'd like to enter. Now, there's this huge disconnect, right, in the population, right? The reality is that, again, 70% of us will need care. It's expensive. But the reality is right now, fewer than 1 in 30 Americans owns long-term care coverage, and only about 7% of us over the age of 50 have long-term care. So there is this huge opportunity for education out there amongst the workforce. But still, according to SHRM right now, 32% of employers offer long-term care insurance as an employee benefit. Now, I say only 32%, but that number has really jumped up. 7, 8 years ago, you're talking that number was in the teens, right? 17, 18%. We have seen a huge uptick in organizations of all shapes and sizes bringing these life with long-term care solutions to their workforce. And ironically, when you poll executives, long-term care does tend to be one of the most requested benefits. And that's probably because they have a financial advisor that's telling them this is an important part of retirement planning. It's an important part of asset protection for your family. And what we find, though, is when we take that same education to the general employee level, it's not just executives who will participate in these types of plans. We see very, very broad participation across the employee base when they're properly educated and properly informed on the solutions. And that's what we see when we bring these life with long-term care solutions. And so when we talk about these hybrid products, this is probably new for some of you. When you talk about these hybrid products, and Sarah, I saw your question, I'll get to it in just a second. The easiest way to understand these hybrid products is that they're a combination of life insurance and long-term care, all combined together into one program. So people can receive death benefits when they pass away, their family will receive death benefits, or if they need long-term care, they're going to receive long-term care benefits. They're very similar, right, in terms of the needs. They're all about protecting families and protecting assets, but the long-term care portion is also about protecting my freedom of choice when it comes to my care options. And these hybrid products are really, really appealing to folks for a number of reasons. The left-hand side really details these reasons. I mean, number one, I think the biggest one is because when somebody buys one of these hybrid products, they know they're paying for something that one way or the other is going to pay a benefit. I'm either going to pass away and my family's going to get the death benefit, or I'm going to need long-term care and we're going to get those benefits. But one way or the other, there's going to be a benefit paid. Guaranteed acceptance underwriting. All the employees of your clients are going to be able to get a very high level of coverage without answering any health questions. That's a key thing for anybody that's had a pre-existing condition, because standalone long-term care can be difficult to get if you've had a pre-existing condition. Also, stable premiums. They're able to lock in a rate that they're going to be able to keep for the rest of their lives. Now, these plans are indemnity products, not reimbursement products. So that means that they can pay benefits regardless of my cost of service. So for example, if I'm receiving care in my own home and my spouse is my primary caregiver, I'm not going to get a bill for that. But these plans can still pay benefits even in that scenario. And they do pay benefits during periods of informal care, where maybe my spouse or my adult child is my primary caregiver. And some plans actually accumulate cash value over time because it's tapped onto a underlying whole life plan or a universal life plan. So it's going to work like those plan structures do. And the plans are portable, so I can take it with me when I change jobs into retirement. Rate stays the same, benefit stays the same. I'm going to give you a quick snapshot of how these plans work, these hybrid products, just a general snapshot. Certainly the structure varies depending upon maybe the state you're located in, maybe the carrier we're looking at, but this is a pretty good general overview. So top left-hand corner, these plans all have a death benefit, and they're going to work just like you would expect life insurance to work. If you have this plan and you pass away, whether you ever need long-term care or not, that death benefit is going to be paid to the beneficiary. Top right-hand corner, there's a terminal illness component. If I'm diagnosed with a terminal illness, I can receive 75% of my death benefit right away, while the remaining 25% is paid to my beneficiary when I pass. Bottom right-hand corner, this is my long-term care component. If I'm in a long-term care situation, I'll receive an amount equivalent to 6% of my death benefit per month for up to 17 months of requiring long-term care. Now, after 17 months, if I still am living, if I still need care, it will trigger the lower left-hand corner, my extension of benefits, which would extend that benefit for an additional 17 months. So I have a total of 34 months of available long-term care payments. And then even if I pass away during that or at the end of that, my family will still receive my full death benefit. So my death benefit on most plan structures does not reduce because I utilize the long-term care. It's always going to stay whole. Now, the trigger for long-term care benefits, for those of you that aren't familiar with that, is just the inability to perform 2 or more of the 6 activities of daily living or severe cognitive impairment, which could be like Alzheimer's or dementia or anything of that nature. That's a pretty standard definition that you find on long-term care plans, 2 of 6, or severe cognitive impairment. Now, let me give you a real numbers example of how this could work for someone. Let's say that, I was your client's employee and I chose a $100,000 death benefit. And just to use round numbers, and let's say top left-hand corner, I pass away. Maybe I've had a heart attack or an accident. I never needed long-term care, but I pass away. My family's going to get that $100,000 just like you would expect life insurance to work. My top right-hand corner, I'm diagnosed with a terminal illness. I'll receive $75,000 right away, and my beneficiaries will receive the remaining $25,000 when I pass. Long-term care at the bottom, whether that care is in my own home or in a facility, I'm going to receive 6%, or in this case, $6,000 per month for up to 17 months. Once that 17 months is ended, it triggers my extension, $6,000 a month for a second 17-month time period. And then even if I passed away during that or at the end of that, my family can still receive my full death benefit, which in this example would be $100,000. So worst case care scenario, I go through 34 months of care or more and then pass, my family will have received $200,000 worth of long-term care benefits, my $100,000 death benefit, for total benefits paid of $300,000 on my $100,000 whole life plan. Think of the difference that could have made for John and Mary in the example that we just looked at. Now, certainly there's differences on this plan depending upon the carrier. Some carriers, instead of it being 6% a month, it might be 4% a month for 50 months, right? Some carriers may be longer than that. It just depends on, this is just kind of a general overview. Certainly people can choose more than $100,000 of the coverage. Let's say I chose, $300,000 of coverage. That would give me $18,000 a month in LTC benefit on this example. So lots of different options there for people to choose from. And then lastly, and I'll kind of get to questions, after this, again, guaranteed issue. So for the groups that we work with, this is kind of going to be the minimum of what they're going to see. Employees will generally get $200,000 of life, $400,000 of long-term care, guaranteed issue, no health questions. Spouses will have some level of guaranteed issue. It may be higher than this depending upon the size of the group. This is just to kind of give you a little snapshot of how it works. And then one last part of our block underwriting offers that we have with the carriers is if an employee takes any level of coverage year one, they lock in their ability to buy all the way up to the guaranteed issue level at a subsequent open enrollment without answering any health questions. So if I'm on a tight budget this year, maybe I only take $10,000 or $25,000 worth of coverage. 5 years from now, my budget's in a better spot. Maybe I've had a health concern. I can still buy all the way up to the $200,000, $400,000 level, and I do not have to answer any health questions. What a valuable tool that is for people as they, go through, their working years. This is a special provision on our underwriting offers with most of the carriers. So it's a great benefit to the brokers that we work with and to the clients that we work with as well. Last question or last thing, and then I'm going to get to your questions. So what we specialize in, folks, is helping agencies start this conversation and then execute on the conversation. And so we do a couple of things to help start the conversation. We have some retirement-specific product introduction emails that you can use to help start the conversation. We also co-host educational long-term care webinars with folks that are called Staying Ahead of the Long-Term Care Crisis, Innovative Solutions for Long-Term Care. And we do these for agencies all across the country. It's not really a product pitch. It's about benchmarking data, cost trends, asset protection. And then we end it by saying, like, hey, if this is something you're interested in, reach out to your consultant at ABC Broker and they can point you in the right direction. And then we also have some short strategy PowerPoints that you all can use to help start the conversation with clients when you're doing strategy sessions with them and that type of thing. So a lot of different tools that we provide. And then ultimately what we help with is we help you execute, or we execute on enrollment, again, to deliver results that are 5 times greater than industry average. I'm not going to go through all that with you today in the interest of time, but I am going to pause there to see if I can answer any questions. Chelsea, I saw we had a couple things in chat.
Yep, we have two questions in the chat. The first one is, what is the claims process like with this product? What does the member need to provide?
Yeah, so that's a good question. And it varies a little bit by carrier, but not too much. So essentially, I'm going to go back here a couple of slides. So essentially, when someone files a claim for long-term care, their doctor, not an insurance company doctor, but their doctor is going to certify the bottom here that they cannot perform 2 or more of the 6 activities of daily living, or they have severe cognitive impairment. And they're also going to provide a plan of care that comes from their doctor, right? And the plan of care is just like basically like, how are we going to make sure this person's okay? It could be that, the spouse is going to be the primary caregiver, or they're going to have certified care, once a week, or they're going to be in a facility. Whatever that plan of care is, they provide that. That's what triggers the benefit. So there's no bills to provide or anything of that nature. It's just that certification of the inability to perform 2 of the 6, severe cognitive impairment, and then that plan of care. And then that's what triggers the claim, essentially. Okay. I hope that helps.
The second question we have is, do the insurers that you work with have longevity in this field? Insurers leaving this coverage or leaving the coverage has been an issue in the past.
Yeah, so you're right on the individual market, or on the standalone market, right? It has been, right? You've had a lot of carriers that were in the standalone LTC space. Now, for these hybrid products, you have a lot more stability. So the carriers that are in this space are the standard, right? They actually bought the Allstate Worksite division, which included a really strong whole life with long-term care product. You have Transamerica, who has a universal life with long-term care product. You have Chubb, who has a term life with LTC product. MetLife has a whole life with long-term care product. Aflac Group has a term life with long-term care product in some states. It's not nationwide yet. And I feel like I'm forgetting one. Trustmark has a universal life and a term life, life with long-term care product. Now, out of those, the standard, Trustmark, Transamerica, have had these products for many, many, many years, 20 plus years. The Chubb has had their product for a while, and then there's a couple of other newer players. But yeah, there's a lot of stability with these life with long-term care products. And because they're tied to an underlying, say, like whole life product, the rates are locked in. The policy can't be canceled. The rates can't be rose. The benefit can't be decreased. So there is a lot of stability associated with the product. Other questions?
That was the final question in the chat, but everybody does have the ability to unmute if they wish.
So folks, feel free to unmute and ask a question. If you have any more questions you want to ask, feel free to enter questions into chat if you want to. Also, feel free to reach out to us at the contact information you see here if you want to talk about potential next steps for a project with your organization. We really, really appreciate your time today. I'll hang on for just another minute or two to see if there's any last minute questions. Anyone have any questions for us? Okay, folks, really, really appreciate your time today. Thank you so much. Chelsea, thanks for organizing. We appreciate you guys. Hopefully we'll see some of you next month on next month's presentation. Thank you so much.